The bond market and debt securities. The bond market is also known as the debt market, fixed income market, or credit market. It encompasses all trades and issues of debt securities. Governments use bonds to raise capital for infrastructural improvements or to pay debts, while companies issue bonds to finance business expansion projects or maintain operations. Debt instruments date back to ancient Mesopotamia, where assignable or transferable loans were denominated in units of grain weight. In the Middle Ages, governments issued sovereign debt to fund wars. The Bank of England was established in the 17th century to raise money through bonds to rebuild the British Navy. Bonds are traded on the primary market and the secondary market. The primary market involves new issues, while the secondary market involves buying and selling previously sold bonds. Investors can purchase these bonds from brokers who act as intermediaries between buying and selling parties. Corporations issue bonds to raise money for operations, product line expansions, or new manufacturing facilities. These corporate bonds can be of two types based on credit rating: investment-grade bonds with relatively low risk of default, and junk bonds with higher risk due to financial struggles. Nationally issued government bonds, or sovereign bonds, pay out the face value listed on the bond certificate with periodic interest payments. They are considered the least risky and are known as treasuries in the U.S., where they form the most active and liquid bond market. Municipal bonds are locally issued by various government-owned entities to fund projects. They are commonly tax-free at the federal level and can be tax-exempt at the state or local levels, making them attractive to qualified tax-conscious investors. Mortgage-backed securities consist of pooled mortgages on real estate properties, with the investor essentially lending money to homebuyers through their lenders. These securities pay monthly interest and are a type of asset-backed security. Governments and companies in emerging market economies issue bonds that provide growth opportunities but with greater risk than domestic or developed bond markets. These bonds include typical debt risks and are subject to additional political and economic volatility in developing nations. Bond indices track and measure corporate bond portfolio performance, providing investors with benchmarks to evaluate funds or securities. The Bloomberg U.S. Aggregate Bond Index, for example, includes government and corporate bonds with issues higher than $300 million and maturities of 1 year or more. Bonds represent debt financing, while stocks represent equity financing. Bonds are typically less risky than stocks and offer lower expected returns. Both markets tend to be very active and liquid, but bond prices are sensitive to interest rate changes, while stock prices are sensitive to changes in future profitability and growth potential. Bonds can be less volatile than stocks with lower returns and carry credit and interest rate risk. Owning too many bonds is considered overly conservative over long time horizons, and a well-diversified portfolio is recommended. Bonds must be weighed against their risk when considering investment. The bond market involves the sale of various debt instruments by corporations and governments to raise debt capital for operations or growth opportunities. Issuers promise to repay the original investment amount plus interest. The expected return of a bond must be weighed against its risk, with riskier issuers demanding higher yields. Junk bonds pay higher interest rates but are at greater risk of default, while U.S. Treasuries pay very low interest rates with low risk. Yes. While not as risky as stocks, bond prices fluctuate and can decrease if interest rates rise. The sensitivity of a bond's price to interest rate changes is known as its. It's important to consider the risk of bonds in investment strategies. The bond market includes debt securities issued by governments and corporations at various levels of risk. Bonds are typically less volatile than stocks since they pay regular interest and return principal upon maturity. A diverse investment portfolio can include bonds but must consider the balance of risk and return. Here are 2 key takeaways. 1. Governments and companies use bonds to raise capital for various projects and operations. 2. Bond markets involve primary and secondary trading of debt instruments, with investors purchasing new issues or existing debt through brokers and other third parties. Hope this would help. Thanks for watching.